And Adem, a lot to talk about. Welcome back. How are
Hey
you?
guys, how are you
How
guys
are you,
doing?
buddy? So I've seen, I see your tweets come across quite a bit. You're getting pretty prolific in your writings and reports and everything. Um, what's top of mind for you, Adem, today?
Are you guys able to hear me real quick?
Yeah, we got you.
Hey, okay, good. Sorry,
And,
my
and
thing wasn't showing.
I did discover you, didn't I? I mean,
Yeah,
you
you
didn't
did,
have
and I
followers and stuff.
appreciate it,
So
Dale.
I don't know.
Dale.
You owe me, man. You know how
Yeah,
many
I'll make
people
it
I've
up to you.
I've made stars and then they don't even retweet my stuff. You know what
Yeah,
that's like? Huh? I'm
yeah,
kidding.
that would be pretty.
You,
That would be
huh?
pretty annoying.
Well,
That would be pretty annoying.
I give and give and give. Anyway, buddy, what are you thinking about here with rates heading up and the Fed coming up and NFP coming up and credit being restrained, and with yields going up, does this put more pressure on the regional banks because of their duration trade? When are we going to move to solvency issues? We've
Um,
had the liquidity issues. Is solvency next to them?
yeah, I do think, and just to put that into context, yeah, the bank issues are every Fed hike is going to make it worse, and I mean, I thought they were going to pause in March this year, but it ended up blowing up SVB and
Yeah,
then the three other big banks. Now we have, yeah, I mean, the
bank
the stress
credit.
tests recently, so this right here is just the bank
Yeah,
credit, and this is something everyone's focusing on employment and everything, but the thing is with employment, there's structural issues in employment.
yeah.
So for instance,
Not enough
Germany,
workers.
yeah,
Yeah,
literally Germany has record low unemployment and they just fell into a recession. The Eurozone right now as a whole is having
yeah.
its lowest unemployment rate since the Eurozone was created,
Can
and
I
it
can
just fell
I
into a
ask you
recession.
something? Because
What's up?
you are bringing that up, and Europe, there being more recognition of recession in Europe than anywhere else in the world. I remember many years ago, I interviewed a gentleman named Martin Armstrong, and he said the way the crisis will develop is that it starts in Europe, rolls to Asia, and then lands upon the shores here in the U.S.
That's
Last.
that's
Do you
true.
like that sequence?
I mean, so of course it's, yeah, I mean it makes sense because, well, first off, Europe and like Japan and China, the three of the four largest economic blocks in the world, they all run current account surpluses. So meaning they have to export more than they're importing, or I should say rather that they have very weak domestic demand in those economies. So with the US running such a large chronic deficit, even though it's been declining recently, like imports were down last month, and it was mostly the big drop. It was like -8% in consumer goods.
Oh,
Once those countries tip over or they start slowing, in such a globalized world, I would imagine it would come to the US after. And, the job data today was good, but, or I don't, did the job data come out yet? It was looking like it was
yeah.
going to be pretty
It
good.
was
Yeah.
stronger than expected. I mean, look, you have the 10-year got to 3.95, 4% today, close. So, I mean,
Yeah.
what do
I
you
know
think?
that
I mean,
might,
really, last time the bond market did lead the 21 bear market in equities. And when you think about it, the bond market's been sideways stable since last October. And if it can't get a bid on a flight to quality, um, it could be leading a correction in equities again.
yeah, no, it could. I think equities have a lot of issues facing it. Just earnings are looking pretty bad. Earnings growth, global credit impulse. Yeah, on that chart I was showing, the bank credit has just completely tanked. I mean, I mean, literally, it's about to be negative year over year. And historically, when it gets big drops, that's not a good sign for the economy. Mainly because banks are the outlet for money creation, right? You create a loan and you're expanding, you create an equivalent deposit and you're expanding the money in circulation, right? The liability side. The problem is when you have banks now tightening credit, or they're cutting back credit pretty sharply, but then on the other side you have debt repayment. There's a massive amount of debt in the system now. You have student loans, you have all coming back on, and you have all that pandemic era debt that you have to, as a consumer, you have to either save or dissave, right? And if you're saving and you're deleveraging, repaying debt, like this is what's happening in China, but it's also going to happen in the US because, we learned from Hyman Minsky, private debt can't go up forever. When debt repayment surpasses new credit creation, that's deflationary. That's literally creating net negative drain on the money supply. And I just don't see how you can have equities rising. And granted, there is a lot of deposits in the system still, but you remember, it's not a stock issue, it's a flow issue. And in my opinion, when we're looking at the flow, the rate of change on bank credit, I think it's pretty underrated. And I was doing some research on this actually, and in the last 4 times that the bank credit, after it peaked and it dropped over 1.5%. So bank credit from after peaking in March, it's down like 1.61% as of the end of May. And every time, or the last 4 times in history, that bank credit dropped at least negative 1.5% was 1975, 2000, 2008, and then May 2023. Each time, besides the current one, the last 3 times, stocks got slaughtered like 40%. So I don't know. I don't want to confuse causation and correlation, but in a highly dependent credit world that we are in, no doubt. I mean, you need ever more credit to get it, eke out smaller amounts of growth. I just don't see how banks tightening is going to at least help anything at all.
So what were the two you were comparing? You're comparing credit to what was the other part of the equation?
Oh,
when something is bigger than that.
Oh, yeah. So in banking, you have to, so when you create a loan, right? Let's say bank A writes a loan, they take the asset, that's an asset for them. But it creates a liability, which is the deposit for whoever.
Okay, so deposit.
So if I'm a bank and I make a loan to you, the bank locks in your loan to them as an asset, and now you have that cash, but you could take that cash out tomorrow, right? You could just literally get the loan and be like, hey, give me cash. And that's kind of the problem, is that when a bank expands their balance sheet, yes, they're taking on assets, but at the same time, they're also taking on liabilities that could go out the door very quickly. And that's kind of like with SVB, we saw you had more deposits leaving. And this is kind of the big issue with banking right now is, one, the recent Fed stress test and analysis of banks show that they're borrowing extremely heavily from the federal home loan banks. They're like using them to over $1 trillion. I think now it's back to 10% of banks.
Wasn't that facility opened up after SVB, and they're still going to the window for all that money?
Yeah, so discount window, discount lending is
so banks are still going, they're coming for the cash that's available through the facility still months after those failures.
So the thing with banks historically, or at least I remember learning this when I was working as an banking analyst, is that you don't want to borrow from the Fed. Like that's the last thing they want to do. Like the discount window, it's there, but one, it's pretty costly. And two, it's a kind of a mark of shame, because if you have to go to the discount window at the Fed, it kind of shows you that the interbank,
you're in trouble.
Yeah, it hurts your confidence. So for them to be still using it, plus BTFP, they usually go for other sources. And the big one has been the Federal Home Loan Banks, which is like a government sponsored enterprise in the US. And they're lending at a very high cost for these banks. Actually, in the last quarter, banks paid out more in net interest due than they made in quarterly profit.
Wow. So they're getting squeezed on the rollover of debt. So you know what's happening every day. There are resets from yesterday when things were cheap, right? So that continues. It's like death by 1,000 cuts. It doesn't show up, but you know, between people and corporations and state debt and municipalities and government and corporate and junk and all of that, people have to roll over at 4 times the cost. You could probably just, you know, compare it to people who've had resets in mortgages, which is, you know, isn't a big thing in the US, but say the UK and
UK's totally
Canada
burned.
and Canada, so that they do feel this increase in rates, where maybe that's why the consumer still has some juice, is because of the 3% mortgages that they're locked into here in the
Yeah.
US.
Well, see, that's the big problem. Well, not problem, but I should say bifurcation in the world is that the US does everything it can to promote consumption. Like you said, we're the only country with a 30-year fixed. I mean, that's a huge subsidy to have. Now they want to do a 40-year. They have pretty generous social security programs, welfare programs, you know, unemployment insurance programs. They do everything they can, you know, Medicare, Medicaid, to just keep consumers going. We have a very low savings rate in this country, but it has to match the other savings rates of the world economy. And if you look at like Germany, 30% gross savings to GDP rate. America's is like 14. China's is 45%. Japan's 30. The only other big deficit country in the world is the UK, really. It's right behind the US, even though the US is like 4 times bigger as a deficit. But their gross savings rate is also like 15%. So you can see a trend, like the bigger the deficit, the lower the savings rate, and then vice versa. And when and it makes sense, right? Because if you have to absorb the imports from the rest of the world, because if they're running a surplus, someone has to run that deficit somewhere else. It always has to net out at zero globally. And if they're not consuming what they make, meaning they're saving more, that they're exporting that capital and those goods abroad. And the US and the UK are pretty much the 2 major deficit countries in the world, mainly the US, obviously, but they have to absorb it all. And it's kind of it's become a problem like globally now, because when you have a current account deficit, the common way of how it works with the US too is, let's say Japan runs a trade surplus with Sweden, for example, but so it doesn't even affect the US, just on a balance of payment. But since the US is a reserve currency, if Japan, who's running the surplus, says, hey, I want to be paid in dollar assets, that means the US has to expand its current account to get the dollars to Sweden. You know, they use a swap line or whatever they use. Sweden, they'll go on, convert it or whatever, but the US has to create the assets or give the assets to Sweden, which is used for Japan. So even though it doesn't affect us with the actual trade balance, the US has to accommodate that by creating those assets. And the most common way of doing it is by expanding credit in the system. So as all these other countries are running surpluses and choosing to be paid in dollars, which they all are, the US has to chronically run that current account deficit to supply them with the dollars, which expands credit and it floods into the household. I mean, because mainly if, you know, they say savings equals investment, but if investment's lagging, which it is sharply, investments down in the US pretty heavily, which makes sense. We're not constrained by savings anymore, but also investments down domestically. And that money has to flow somewhere. And it's chosen, there's a lot of good empirical evidence on this, but it's basically flowed into the household sector instead, and governments, mostly household sector.
Okay. So your last article and piece that you've been working on, you want to share that with us
Oh yeah, I was
for subscribers?
yeah, anyone on my free site. This one was I don't know if you guys follow China much, but China is I know you and I talked about this like a year ago, and I didn't believe in the China hype at all, and I think it's worked out pretty well, just mainly because of how the structure of their economy. Like they're right now entering in my opinion, a balance sheet recession, which is what I was writing about, which means they're one step away from what Japan did. And a balance sheet recession, just to give anyone context, it's basically when consumers get so leveraged already and they turn away from new loans. And we're kind of seeing that in the US already. Like we've seen loan demand fall. And what happens is it doesn't matter then what a central bank does, because the central bank believes, that's their orthodoxy, that if loan demand is weak or credit is tight, you cut interest rates, and then rational investors will take advantage of it, or consumers, because they can, spend now at a lower rate. But we know that markets don't work rationally most of the time, or economics. And that's what happened in Japan. It didn't matter if they cut interest rates. If nobody wanted to borrow because your asset prices fell, like in China, we're saying their property prices sank, which was their largest household wealth was all in housing. It was like 75% of household wealth in China was in housing itself. So when you have,
they're all stuck.
When you have property prices fall, exactly. And when you're stuck, you don't want to take out new debt. Instead, now you have to pay back debt with an asset that's declined, but your debt's in nominal terms, right? So, and not to mention, China's already in deflation. They're in CPI deflation and PPI deflation, so producer and consumer inflation. So that real debt is getting more expensive for them. So, and we can see that perfectly. The chart right here. No, next one. Yeah, China's household debt to GDP. See how it boomed from post 2008. It more than doubled. But look where it's been since 2020. It's literally flat. It's actually been declining since 2020, mid 2020, and that tells us that the Chinese are not taking on new debt. And it makes sense. And this is the point of the balance sheet recession, because it doesn't matter. So right now, China's trying to cut interest rates. All it's doing is hurting their yuan, but it's not stimulating borrowing. And that's the same thing that happened with Japan, because it's like, it doesn't matter if you cut interest rates if nobody wants to borrow or has the capacity to borrow any further. And you can't get growth and interest rates fall essentially negative. Like they'll just keep falling until there's loan demand. And a big reason for China saving so much is because of this. They have a massive population crisis coming out. They're getting squeezed on both sides right now. They have 21% youth unemployment. That's as bad as the pigs nations right now in China. Like that, it's gotten really bad. And that's another, I think 11 million graduates just graduated into that market. And you have a huge elderly population retiring. And like we were saying earlier, they don't have safety nets. They don't have 30-year fixed. They don't have Social Security. They don't have Medicare. So they have to save for their retirement and their health costs later. So they're not spending their money, and they're not taking out their new debt at this point, this older generation, at least so far. So it doesn't really matter what the central bank does. And yeah, I wrote this like a week and a half ago, but the yuan now is what, 7.25. That's probably their new line in the sand. But I mean, it's gotten really battered over their reopening just on their problems. And yeah, I think China's actually, I fail to see also China's consumer confidence is completely shot, which makes sense. I mean, you can't get the consumer up. Their banks are drowning. Like this is a bank margins of Chinese banks. It's below 2% now. I mean, they're drowning in toxic debt. So to me, I also think that in a globalized economy, like you were saying with Europe, now you have, because you remember in like after 2008, Europe was still chugging along until 2011, 12. And China was obviously roaring after 08.
Yeah.
Well, now
China
the other
brought us out. Yeah, China's brought us out.
Yeah, commodities, everything. They were really, I was reading an IMF paper. They accounted for like 40% of global GDP in that decade, just that country alone. But it's gone now. I mean, now obviously they expanded very rapidly, took on a massive amount of debt for infrastructure investment. And now they've hit the law of diminishing returns. And I don't see a way how China could also fall or weaken. Now the Eurozone also, and Japan is pretty anemic. And then where's the global growth going to come from at that point? I mean, the US can do it, but the real wages in the US have not really grown for 40 years. Wealth inequality has gotten worse in America, which means more money is flowing to the few who don't spend, who save more. And you need credit to subsidize spending, right? Like that's, if you take away the purchasing power, the real purchasing power of consumers, you have to keep credit going to subsidize it. And we've seen it in median income to homes sales. It's already over like 7x. So, cars, same thing. Like you need credit or cheap credit to subsidize the gap between your anemic income growth with real income growth with these other assets. And I think as soon as, now that we're seeing US credit tightening, I think that's definitely going to weigh on them, or I don't see at least how it would help.
Okay. What kind of long-term speculative option positions are you taking in this environment?
Yeah, so I think,
and if you're not doing anything, that's fine.
No, I've actually been getting I've actually been looking at shorts on the SMH, the semiconductor ETF, just because well, one big reason is semiconductor sales have collapsed globally. Like horribly. And
even NVIDIA's, would you short NVIDIA?
No, I wouldn't short NVIDIA just because it's very frothy, but I wouldn't buy it. I don't think it's worth what it is. I think it's a lot of hopium, but at the same time, I do think semiconductors as a whole, there's also another big problem. Not only all the major exporting economies of semiconductors. So you got Hong Kong, Taiwan, South Korea. Well, they've all been like double-digit negative on semiconductor sales for the last 6 months. And there's a good chart. I don't have it on me right now, but it was on Yardeni Research, and it shows worldwide semiconductor sales with earnings for these companies, and they pretty much follow each other. So, as long as this semiconductor glut keeps building, I just don't see how earnings. And we've seen Micron and Texas Instrument, even AMD. They touched on these things like in their last quarters. They were saying, it could be harder. And I think people are expecting a big boom in the second half of I don't really see how that's going to happen, but it always
what do you think Yellen's doing over there in Beijing? And China's security over economics, and she's going over there to say, well, we're that way now too. So what's going to the outcome here?
That's the problem. So they're telling them, hey, basically you guys are doing protectionist, because all these economies, they subsidize their semiconductor exports. China subsidizes exports in general, but now the US is like, hey, we're going to make our own chips here. And I get it from a logistical point, like, hey, if we need these for certain missiles or national defense, it's better to onshore it, which makes, I agree with. But at the same time, now you're essentially going to be subsidizing more semiconductor production in the US while every other country is also subsidizing semiconductor. And so now you're commoditizing semiconductors. And what happens on a free market when you have commoditization? It doesn't matter unless they tell American companies you can only buy chips from American companies. You're just going to be adding more supply into an over glutted market at this point. And I think that's my big concern with it, is that militarily or strategically, I get why they're onshoring it, but also for the actual quality and price of the semis, I just think it's not like these other countries are going to say, hey, our main exporter semis are, it's a main export for us, let's just not compete with the US. No, they're going to just ramp up their more subsidies for them. And I think what happens when everybody's ramping up supply at the same time, I just don't think it looks good.
What a great call, man. Thanks for sharing that with us, and another excellent interview. As you can see, Adem doesn't look at the surface. He takes deep dives into these markets. Why don't you show the viewers, attendees, where they could follow you on your website.
Oh yeah, you guys can all just check out my site. It's just speculatorsanonymous.com.
Yeah.
And
Yeah, Radical Adem, ADEM on Twitter. Follow this guy. And do you do the artwork on your website?
I've actually been using the AI. I've been in my Van Gogh stage right now.
Look at that.
So I've been like using the AI art generation.
Look at that. Oh man.
Right?
Yeah, well, I tell you what, bro, next time I do shrooms, I'll come to your website. All right, buddy.
Yeah, that sounds good.
Anyway, really interesting take on everything and boiling it down to an opportunity on the short side of semis that everyone's afraid they're not going to have enough of, but yet there's a glut. Very interesting thinking, Adem. I'm glad I discovered you, and I'm also glad for all the success that you're having. My hope is that it continues and you mushroom out from here.
No, I'm definitely very grateful, and it's been
all right. My bank wire number is 853588652.
Right.
All right.
Great. Good
anyway, get a hold of me on Twitter. Do you miss TweetDeck?
I actually don't even know what TweetDeck is.
Oh, well, then you don't miss it. Okay. I'm the only one going through major withdrawals. I miss it.
Yeah, I never even knew what TweetDeck was.
Yeah, so AJ's posting your Twitter handle here. And,
thanks, AJ. I see it.
All right, so
thanks everyone for listening and everything. I appreciate your time.
You bring some, some great ideas, and your strategy is a very interesting spec. And let me wrap it with this. So when you do it, I know you do it with options. So say you're looking at SMH, how much time would you buy on a idea like this?
Probably 6 months. Yeah, I would look across the volatility curve. I like to use the if you're familiar, like Nassim Taleb and Mark Spitznagel. They have a lot of good papers you guys can find online on their heuristic option pricing model, which is counter to Black-Scholes, and they just say what they look for potential. It's like options are like you'll get a lot of paper cuts, right? But if you buy them, obviously I'm not selling these and unhedged or anything. Jesus, that's a good way to blow up. But if you're buying the options, like the worst case scenario, let's say I buy $500 worth of these calls.
You lose 500.
Worst case, I lose 500. I already know. It's like buying car insurance. I already know what I'm losing. But if that black swan happens, or like when I have my TLT bond, I was long TLT pre-SVB, right? When we used to talk about it, I was like, I'm being conservative now. I'm just liking bonds. I wake up one day, SVB booms, the curve completely started steepening again. It's like 300%, 250, 300% on those. And it's like, it lets my ignorance and time do the work for me. So I like to just throw it like a fishing line.
Yeah.
Probably I won't catch some fish, but sometimes if I do, it justifies the returns of the others.
Okay. What a great little mini primer on attitude of an option trader. So thank you, Adem. Good luck the rest of the summer, man. We'll get back together in the fall. Yeah,
sounds good, Dale, and everybody else have a good day.
Yeah, stay real cool in Arizona this summer. All right, buddy?
Yeah, it's a pretty hot one.
It's hot where I'm at too, bro. I'm just.
Oh yeah, I've heard.
I hate this time of year. Anyway, so thank you, Adem, everyone. Some added value from Adem, and you can join the team in 15 minutes on the morning edge. Remember, don't just count your pips, count your blessings. And that goes for you too, Adem.
Great. Thanks, Dale.
Are you going to do that? You promise?
Yeah.
Right. I want to hear you say, I promise. I'll do that.
I promise. Gotta be stoic. Gotta be stoic.
All right, brother. All right. Take it easy, everyone. All right. Bye-bye. Peace.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.